Welcome back, everybody. Hope everyone's having a good Monday. Hope everyone had a good Valentine's. Hopefully, no hangovers. And yeah, so today we're going to be talking about daily swing highs and swing lows. And more importantly, we're going to talk about how we can find ways to not get lost in price when we map out our swing highs and swing lows because, you know, having been teaching for such a long time, I noticed that there are a lot of times in where I may teach somebody something like an order block or swing high or swing low, and then they'll just go crazy mapping out every single one on the chart. Now, from like a repetitious standpoint, if you're trying to just get your reps in so that you have that pattern recognition locked in, that's fine. That's good. I encourage that, get your pattern recognition down. Uh, but once you complete that phase, right, of now you can recognize pretty easily, these price signatures, then you have to start to move on to the next layer of that, which is, well, anyone can find an order block, right? But how do we find an order block that's high probability or relevant, let's say, right? And we kind of know a little bit already in terms of using, swing highs, swing lows from very specific points in time, time windows, right? Session highs, session lows. We know that market structure breaks, we create high probability fair value gaps, right? So we have already kind of touched a little bit on this, but specifically, I want to focus on daily swing highs and swing lows because you could do it on the 4 hour, um, but the problem with the 4 hour is you're gonna get a little bit too much detail, right? And the problem with the weekly is you're getting a little um, too little information. It's not getting to you fast enough, right? So the daily really is the sweet spot that we want to kind of focus on, right? If we are day traders and we can focus our analysis primarily on the daily time frame, um, that's going to lead to trades where we're only in it for, say, a few hours max, sometimes even just a couple minutes, right? So if we can focus specifically on the daily and talk about what makes a um, what makes relevant swings, we can start to put together a framework, right? A method to create a framework that will give us just enough detail that it's not so overwhelming and it's not too little, and that it can be practical to us, right? So we're going to be talking about four different concepts today, right? And I mean, they all kind of fall under the same thing. Um, but we'll be going over four different things. Okay, so first one is the main topic of today, right, which is relevant swings, right? And in order to delineate what a relevant swing is, we're gonna have to understand what failure swings are, right? Which some of us kind of already have a surface level understanding of what failure swings are, but we're gonna go a little bit deeper today. Um, Then we're going to look at price separation, which this is one that we have not talked about yet. It's going to be new. And then we're going to also talk about the look back period, which is also new. Okay. So even though this may feel somewhat like review, it's really not. I mean, I guess in some form because we are talking about swing points and we've done a lot of focus there, right? So if anyone here is new and you don't have no idea what I'm talking about, you don't know what a swing point is, you don't know what failure swings are, um, let me know because I'm not gonna leave anybody behind unless it's your fault and you're just not asking questions, right? Everybody here had to start somewhere, so no need to feel embarrassed or something for asking a question, right? So with that being said, right? Um, these are going to be our three steps in order to find relevant swings. So the culmination of these three concepts are what is going to answer the question for us of what relevant swings are, right? And the first thing that we just talked about was focusing on the right time frame, okay? Um, the daily is the most important time frame, right? This is where you're going to get the most frequent slash reliable setups. Right now, a lot of us, we've been using the weekly, right? Um, and there's nothing wrong with using the weekly, but just like as a very like quick example of why we may not want to use the weekly for our analysis is gonna map this out right here. I know everybody probably sees the fair value gap and the volume imbalance. I'm mapping out this whole thing because it's a suspension block, which we'll talk about suspension blocks maybe today. We'll see. But just note, right, that typically with our frameworks, we go on the higher time frame, right? We find a bullish PD array or bearish PD array depending on our bias. Clearly, right, we're very bullish here. So we're gonna take our weekly suspension block, right? We're gonna map out our weekly ERL is our target, right? And so we have a framework set here that's based on the weekly, right? And we're gonna look at a setup that I had called maybe a few days ago or so, right? Where we hit a key level, right? And then we make an inversion, okay? This model, right, and obviously there's a little bit more that goes into it than that. This model, I call it the GOS, okay? And most of you guys are familiar already with that essentially what we're looking for is hitting a key level, then looking for some measure of a market structure break, aka confirmation. And we know that market structure breaks can take place in form of disrespecting a bearish fair value gap or a market structure break with ERL, right? Closing above a swing high or closing below a swing low. So we use the inversion, right? And this is the setup that I had called out. Like I said, it was maybe a few days ago, something along those lines, right? And we're looking for something like this. Obviously, we talked about where we would partial out, but just taking a look real quick, if we kind of measure this out, it's already been 2 weeks since that call out, right? And this is kind of the problem that you may find yourself experiencing if you're using the weekly, that you're in it for too long. And even so, right, even if we went down to the 15 minute, we could cut down the time somewhat, right? If we drop down to the 15 minute and we wait till we hit the weekly key level, right? So we hit it here. Notice, right? We have an inversion. We take a loss there. If you took a trade in Asia, maybe most people here don't trade Asia, so maybe you didn't take a loss, but we get an inversion down here, right? And this is obviously a much more optimal play for us, right? In the sense that the time expended is going to be significantly lower than what we would take if we were using just the 4 hour, right? We can get a 2 hour pretty quickly, right? We look at the time real quick, see how much time is elapsed since that entry. 5 hours, which is not bad, especially if you're comparing it to um, 14 days, right? Or 2 weeks. But the problem that we encounter when we use the 15 minute or when we add it in is we're a lot more susceptible to fake outs and false moves. Um, Again, it's not none of this is to say that you can't make money using these time frame alignments. It's only to say that um, when you have a daily key level, right? Um, or you're framing your trades from the daily, things are gonna happen a lot faster, right? So let's take away this weekly suspension block. Let's look at this daily fair value gap, right? We'll map out this ERL. We'll go into the 1 hour. There it is. We'll go into the 1 hour. We can see that after we hit the key level, we get a change in state of delivery here, right? We can enter based upon that. That's one of our entry techniques, right? We can put our stop loss at the low, and we can get a very fast move, very fast 2R up into these equal highs, market maker buy model, right? Everyone should be able to see that by now. And notice that the time elapsed is quite quick, right? Um, this is not the hourly. Oh, okay, it jumps to the next day. So like I said, right, and we can do the exact same thing that we did earlier, right, where maybe we break it down to even a lower time frame, right? We can jump down to the 5 minute, and we can wait till we hit the key level. There's our inversion. Okay, we can go 1 to 1 or we can go 1 to 2. And this one takes a little bit longer. We enter a period of consolidation, which that's fine. But you guys get the idea, right? So going back to this, we want to be focused on the daily, right? If we are day traders. Now, if you guys are swing traders, I mean, you can disregard the information if you'd like. But most of us here, I assume, don't want to be stuck in trades for longer than we have to. Most people that you want to get your money, get in, get out, and not have a position open for more than a few hours at least, right? So with that being said, let's talk about failure swings a little bit more. So just as like a small recap, right? What is a failure swing? A failure swing is when we can see that swing highs fail to take out other swing highs, right? Um, and that's why we call them failure swings, right? They're failing to take each other out. Now, if we want to get a little bit more specific, right? We want to look at, let's take a look at this swing high, for example. Okay. I want you to notice that price digs back into that level, right? It goes back into the swing high and then it fails, right? Let's look at this example. We create a failure swing by moving into that swing high, right? And this would be the more specific definition of what a failure swing is when we actually move into that candle's high, but don't take it out and reject, right? So those are the kinds of failure swings um, that we're going to be mainly focusing on today, because the thing that you and I need to do when finding relevant swings is we have to ask ourselves, what are the extremity highs and lows, right? An extremity meaning what are the extremes, right? Because we can trade off of maybe this swing high, right, being taken out. Or maybe we could trade off of this one, right? But the reason that we wouldn't trade off of a swing high like this is because it's encapsulated inside this failure swing pattern, right? We never want to trade in the direction, or sorry, we never want to trade away from failure swings, right? We want to trade towards them. Okay, so the reason that we're talking about this specific definition that we're using here is because we have to focus on price separation, right? So let's look at an example of what I'm talking about here, right? So let's look at this leg, okay? I want you to think to yourself, what are the extremes in this price leg right here, right? What are the extremity highs and what are the extremity lows, okay? So the answer to that would be, this would be the extremity of lows, this would be the extremity of highs, okay? Now, notice we have a swing low here, But this one is going to be irrelevant. The reason that it is irrelevant is because it's a failure swing. If it's a failure swing, then we do not consider it to be a relevant swing for us to take a trade off of, right? But if we only use extremity highs and lows for our setups, that's when we're really going to get high probability trades, right? Because maybe something could happen at this swing low, but we know for sure that if we can get the extremities, then we're definitely going to get something, right? So this idea of price separation is very important, okay? Because if price is not separated enough from the swing low to swing low, then it's going to be deemed as irrelevant. Okay, so if a high or low is part of a failure swing, we don't really want to trade it. We want to be trading at the extremes. Okay, so let's look at a couple other examples, right? We have these extremity lows and this extremity of highs. Now, why is this high relevant, right? Because you might see this and say, well, this just looks like another part of the failure swing, right? But if I map this candle out, look at the distance between these swing highs, right? Visually, something like that. That price separation is what tells me that this swing high is relevant, okay? Now, why would I not be using this low? Why would I be using this one? I would be using this one, because this one is just a failure swing, right? It digs back into this low and then rejects, okay? So that idea of price separation is another thing that's going to help us build relevance to, you know, where we want to be trading, okay? Or what highs and lows do we really want to be paying attention to when we're looking for setups, okay? Because today, what we're mainly talking about is the is this is part of framework, right? We've done some framework stuff, we've done some confirmation, we've done a little bit of execution stuff, and now we're coming back to add some more stuff to that framework, okay? So now let's talk about the look back period, okay? So once again, as you guys know, I trade primarily ICT based concepts, and I also mix in time dilation theory. But one thing that ICT talks about is the look back period, right? That the algorithm in which we take advantage of when we trade using these concepts is going to refer only to a specific amount of time, right? So what the look back period is going to do is it's going to keep us from deviating too far in time and mapping out certain certain swing highs and swing lows that are really no longer relevant to us, right? We're not really going to be looking at swing lows or swing highs from months or years ago, right? We want to be looking more in the realm of recent price action, okay? So what the look back period is that we're going to take the past 30 daily candles, right? Not calendar days, um, but the last 30 daily candles, right? And one way that you guys can measure or find this is by using the measurement tool, right? Or um, you can do shift, left click, and then drag to do the same thing. But in reality, it's just using this tool, right? So if we go ahead and we measure, right, the last 30 days, we'll put a vertical line. I only care about the daily swing highs and swing lows inside of this period of time, right? And of course, as the days go on, we can move it forward, right? But the swing highs and the swing lows inside this period are what I'm mainly concerned about, right? my fault. Mic disconnected. But anyways, well, I mean, I suppose you could, uh, but this is mainly for the daily because the look back period, I mean, like you wouldn't need to really do it on the 4 hour if you did it on the daily, right? Because if you do it on the 4 hour, 30 candles, like once again, you're getting a little bit too much detail. So if you did 30 candles on the 4 hour, you would be looking at just this price range, which to me, you know, if we're using a framework, right, we want those levels to be very solid and reliable. And if you notice, right, we have relative equal highs right now, right? So everything encapsulated in this time period, right, is going to be of relevance to us. Okay, so there are no other swing highs until this one, right? But these two are obviously the extremities, right? And they're a lot easier to see as extremities because of that look back period. Okay, so we can see from the last 30 days, right, what's happened. I always like to map, you know, what's going on in those 30 days, right? And if I can focus myself just on this and I'm not looking everywhere else, it's going to be significantly easier for me to focus, right? Um, any questions so far? Okay, cool. So, once again, just to kind of recap, the way that we can find relevant swings is to make sure that there is enough price separation for something to not be considered a failure swing, right? And we have to kind of think of this new definition of failure swing when we talk about that. Low resistance liquidity and failure swings are not necessarily the same thing, right? Low resistance liquidity is what we see on the first part of a curve on a market maker model, right? So that kind of like trend line liquidity. Failure swings are when we move into a high or low, but we fail to take it out, right? So if something is touching that swing high or swing low and it creates the failure swing there, I'm not going to use that one, right? I want to be using the extremities specifically, okay? The look back period is giving us a window of time so that we're not going crazy and we're not coming all the way back here looking at these swing lows or these ones, right? Now, if you're going to do macro time frame analysis, that's a different story. But as I said, um, if you do your analysis on the daily, you're going to get very good day trades, right? So for swing or long-term positions, does not apply, okay? So that's the main concept I wanted to go over today. And if there's no questions, we can get into the market update stuff. And then I think some people had sent me some charts. Kickass sent me something interesting that we can talk about. Did if anyone sent me like homework or something, let me know because I genuinely I can't remember who did or who didn't, and if they even wanted to go over it or not. But yeah, so let's get this market update out of the way. Okay, so doing what we had on before, let's put our projections up. As of right now, we are in the retracement slash reversal zone. Okay, and this is important because not only are we in a retracement or reversal zone, but if I take this whole leg and I cut it in half, we are deep in discount right now, just under these lows, right? So we have two things that can happen. We can move back up, potentially inverse this fair value gap, right? And then we can push higher maybe into the second one, and then we would have to kind of monitor price from there. Um, but there's a potential inversion here, or we can get a retracement back inside this weekly fair value gap, maybe get a 4 hour inversion and then start coming back down into this low, right? And that's kind of what I'm more in favor of right now as it stands currently. How do you select the 0 and 1 in the standard deviation? Um, if you mean, I'm assuming you mean how do I know where to anchor it? I'm looking at the last opposing move before the real move, right? And so what do I mean by that is I'm looking from this high to this low, that's the last move down before the true move up, right? This is the last move up before the true move down. I'm always looking for that leg, which that's the manipulation leg, right? If we want to get specific. And how do I know it's the manipulation leg is because when we run above this low and we create this leg lower and then we market structure break it, I'm already of the opinion, okay, we're going for this high most likely, a market maker model stuff, right? We retraced into a discounted fair value gap and now we're moving away from it with displacement, okay? So same thing here, we have a move up, we take out this swing high, right? We market structure break lower, and then we get the true move. So I'm looking for the fake move, the manipulation leg, right? So going back to what I was saying, I'm I'm gonna be watching for if we can get a move inside this weekly fair value gap, and then we start to break down. Uh, those are shorts that I would be interested in. Okay. Um, if we inverse it, then I'm probably going to start to maybe flip the idea that maybe we're going to be going long until we get into premium of this entire range. Okay, and I want you guys to notice something that's taking place right now on the chart, right? I know this is a pretty big weekly candle, but we are producing inside candles, right? And as we know, inside candles produce what? um, well, yes, inside candles are a form of consolidation, but as to what they produce, yes, they can um, produce reversals, but what I'm really thinking about is they produce explosive movement in price. When we have a collection of inside candles, like these, for example, we get the initial candles range, we get one inside candle, two inside candles. Look at week 3 and week 4. Um, In advanced time dilation theory, no. Inside candles are not, they don't exist. If you could remove inside candles from your chart, um, I would for specifically time dilation theory, but I still do think that they do give good information in terms of telling you that price is stuck inside of a range and when one of those sides of the when one side of that candle gets engaged, we're gonna get a pretty large move, right? Check it out. We get inside candle 1, we manipulate that inside candle's high, and look at what happens as a result. Yep. In Yeah, and only directional are counted, and for the same trend, yes. I mean, you actually in advanced time dilation theory, you can actually do countings on both sides of the trend and look for alignment there. Manipulation, then reversal. Exactly. 100%. Okay. So get ready. There should be an explosive move coming in the next few days, which kind of also brings me to maybe the next topic, and maybe we'll put like a little pause on the what do you call it? The market update, and let's talk a little bit of time dilation here for a minute. Okay? Yeah. Yep. So if you guys follow Inner Circle Morpheus, he's said that the 20th of February should be uh pretty much a shift in trend, a shift in how the markets are working currently, right? And just as like some bullish copium real quick, I just want to bring your attention to um the yearly candle, right? And I want you guys to kind of see something, right? We had a candle 2 closure back inside candle 1, right? If any of you guys are very familiar with candle range theory, one thing that we like to do is not just say that candle 1's low is the target, but that the midpoint is also a good point of reference, right? In an advanced fair value gap theory, which for whoever the guy for Noble Rex, he says, "This is my second time here. What's that thing he says that rhymes with February gap? It's a fair value gap." But that's funny. But for advanced fair value gap theory, we also know that we like to take the midpoint of a fair value gap, right? And let's take a look at what happened previously, right? We went into that fair value gap and then shot back up, right? So just as some bullish copium, this is the yearly chart right now, right? And if we think open, high, low, close, um, or open, low, high, close, and we drop down to the monthly, right? This kind of coincides with what we see on seasonal tendency charts, right? Or how we've seen previous cycles play out. Um, but yeah, so Morpheus says that February of 20th is significant. So what we're going to do together is we're going to try to figure out why he's calling out specifically February 20th. Now, it's very, very helpful if you find somebody who you really respect their charting abilities or their technical analysis, when they post charts or when they point something out, reverse engineering that and figuring out why, you will gain a lot of insight if you can do that kind of thing consistently. So I'm just going to start here from the monthly, right? And I'm going to go ahead and count candles, right? So we got candle 1, I have candle 2. As you guys know, in advanced theory, we don't count inside candles. You still can, right? And you can still get good information from it. But according um, to Morpheus, the more advanced version is to not count them, right? So let's do both. We have 1, 2, 3, 4, 5, right? If we take it away, then this is really candle 4. But we're going to leave it for now, okay? So we've got 1 to 5. For those of you guys that don't know, in the second sequence, it's 1, 5, 9, right? Maybe some of you guys already know that. Let's drop down to the weekly. We've got candle 1. Well, let's actually change this to a different color. 2, 3, 4, 5, 6, right? And without counting inside candles, or actually here, there you go. Actually, wait, did we do this wrong? No, we didn't. Did this one wrong though. Okay. 1, 2, 3. So 3 and 5, 3 being on the weekly, 5 being on the monthly, we're starting to get some convergence of the numbers, right? And if you guys are watching or studying time dilation, the convergence and divergence of the numbers is how you start to put together the idea of when the numbers are converging, you're either looking for a setup or you're not looking for a setup. When the numbers are diverging, you're already in the directional move, so to speak. Right, so let's drop down to the daily and see. And we probably should have done this on NQ, but it's okay. So let's see, let's start from here. We'll go candle 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Okay, so we've got a daily 15 candle. Right, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Okay, let's try and do this on NQ as well. Okay, we'll go ahead and we'll start from the weekly. It's candle 1, 2, and we're currently on candle 3. Right, now we'll just jump straight to the daily just because we have already 2 inside candles. So let's see. We'll start from here. We'll go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Should have moved that. We'll put a vertical line on February 20th. Okay, so I think that would be candle 17. Let's just double check. Candle 16. Now, in time dilation theory, it's not necessarily that every number in that sequence is the significant number. There are a lot of times in where if candle 17 is this important number in the sequence, then candle 16 is where we will put our focus. Um, and so let's also take a look at the Forex calendar. And let's see if we have anything on the 20th, right? Because a lot of times, if you map out your time dilation theory candles correctly, you will find out that a lot of times they map out to these key times. So February 20th, we have a lot of red folder news going on. Um, let's take off everything but USD. So these are going to be the key times to really be looking at price and what it does. Because if Morpheus is correct, I'm willing to bet that one of these times, if you do candle counting on the lower time frames, there's going to be a significant number in there, just from experience, right? So let's see. So now we're going to count backwards. 1, 2, 3, 4, 5, 6, 7. Counting backwards is also part of advanced time dilation theory. If we hit this level on the 20th, then I'm going to be extremely interested. Or if we can get SMT as well at that level, will also be very interesting to see. And yeah, right now we have relative equal highs above. We've made a super deep retracement below these relative equal lows. So I wouldn't be surprised if we take it or we SMT it and then we start moving back up, which it would be a little bit maybe early for price to start reversing and going up. But the thing is that February was supposed to be somewhat bullish and then go lower, but it's just been going straight lower per the seasonal tendencies. So because of that, we can start to conceptualize we can start to conceptualize that if February was more bearish, then it accelerated what we should expect in seasonal tendency. Usually, we're looking for a bottom and sometime in March to April, right? But late February could make sense because of how accelerated price has been to the downside. So, yeah, that's what I'm thinking for why he's pointing out that one specifically. Okay, let's see. So no one sent any charts, right? I don't need to go look at anyone's stuff. I don't think so. Okay, so we'll check out what Kickass sent us. So if you guys don't know, Kickass has been working on pretty much putting a lot of the stuff that we've been talking about into a kind of like format where it's automated for us, right? Where it's giving us key um, key points in price, right? So 4 bearish weeks in a row, expect bullish reversal and contraction. Okay, we've got some relevant order blocks. Multiple reversal counts converge, highest probability of trend change. Watch for rejection at key levels. And this is really interesting because if you look, right, this is about this week. And then we have Morpheus here saying that February 20th is going to be a significant change in direction for the markets, which can only really mean one thing. I mean, maybe I'm misquoting him, but I'm pretty sure it was something along those lines, pretty much alluding to prices likely to, um, you know, move up, right? So let's go ahead and finish the market update. Another thing actually to consider is we have this order block here, and we're just at the midpoint, and we just created a candle 2. Um, so let's see what happens. Maybe on the 20th we create an inversion or something. We'll be looking out, right? If it's an important day, we'll keep our eyes on what leads up to it. But going back to BTC, time dilation theory aside, um, I still am of the same opinion thus far, right? We mapped out that bearish daily fair value gap. We had a really nice move down, um, and then we had a pretty strong move back up. But this just looks like another market maker sell model to me currently, right? We move up. Let's see, maybe what was that key level? Was it the midpoint of this wick? Nope, fell short of it just by a tad. Um, but we do have this bearish order block actually. Yeah, there you go. So at this bearish order block, we have a candle 2 closure back into candle 1, right? And then we get a nice move lower into this fair value gap. Now, if we invert this fair value gap, it's just going to be another signal for us that shorts are good to go. And yeah, we have a market maker sell model here. So I'm still thinking that we take out that low thus far. Now, if we can maybe um, CISD here or market structure break here, then I'll start to kind of flip my bias. Right, in ETH, been looking at the same thing pretty much. Um, we're looking for those lows to be taken. Right, so maybe hopefully Friday, the 20th can send us down lower there. Let me move this, put chat on the side. When do you know that you will not take a trade? Do you have a rule? Yeah, that's a very good question. Um, I will not take a trade unless we engage a high time frame key level. I will not take a trade if we have a search and destroy profile, right? Which is where the session highs and lows, they're being constantly taken out, both high and low. London takes out um, Asia high and Asia low. New York takes out London high, London low. Pretty much essentially like what would you call it? A broadening formation. I will not trade. Um, I will not trade unless we hit an IRL or ERL on the higher time frame. I mean, there's a lot of reasons to not take a trade, but I would say that those are like the main ones. I also don't usually like taking trades if yesterday there was a lot of expansion. So just like cherry picking an example here, this is a super expansion day, right? And the next day is mostly consolidation. Like you can make money here, but that's not, this is not ideal, right? This looks like also like a broadening formation to me. But yeah, so much better to trade the next day over after a consolidation like this, right? And visually, I think that that's yeah, that's like a candle 1, 2, and 3 setup. So yeah, look at Sunday gave us a huge move. Look at today. Not ideal, right? But that's a solid question. Look at this day, crazy expansion, next day consolidation, right? But yeah, you guys get the gist. If we have a really big expansion day, I'm gonna be a little bit hesitant next day over because I would expect that consolidation is probably very likely. For Sol, mm, Sol might be moving into this fair value gap. So let's see. Sol, I probably just wouldn't be touching right now, but we did get that CISD. We are in a bullish reversal candle, or we are in a bullish fair value gap whilst creating a bullish reversal candle. So if we can close like this, candle 3 might be worth trading maybe into this high. But just because of how BTC looks, I wouldn't really be that interested. On gold, we just hit this daily order block. Decent reaction so far. Um, we have some relative equal highs up here. We also have some relative equal lows, right? And kind of even though we're not on the daily right now, we're taking some extremity highs and extremity lows, right? Now, remember, we haven't really moved into this wick, so for this to be considered a failure swing, it's not, okay? So maybe we come back down, take this low, and then I'd be interested in a trade. But I think gold is gonna make a pretty big move again soon because look at what we have. Inside candle, inside candle. Look for one of these sides of the ranges to be manipulated um, before you decide on taking a trade, at least on gold. Silver just doesn't even look interesting to me. Is there any other requests? Is there anything you guys want to look at? Trade ideas on Friday. Yeah, let's see. All right, let's see. What day was Friday? Was it the 13th? Yeah. Okay, cool. Let's see. Asia consolidation, London consolidation. Mm, was this on Friday? Let's see what maybe we can find on our chart. Let's see. Friday's here. Okay, yeah. You're looking at this. Okay, so let's see. Let's go back. All right. So, well, you get stopped out here. Yeah, you didn't get stopped out in London. So this is where I'm assuming this is where you got stopped out. Now, when I look at the 4 hour candles, I can see we have an inside candle that this is going to be the Asia 4 hour candle. This is going to be the London 4 hour candle. And this one's likely going to be the New York candle. So the reason that I would consider it wrong is because, look, if you're not going to use a higher time frame uh, level, then you have to use session liquidity and the 4 hour candle profile. If you would have waited until Asia's 4 hour candle was manipulated higher or lower, then I think you would have had a better shot of taking a trade, right? Now, if you took this inversion, well, I guess there is no inversion there. So right there, right? When we start manipulating below that low, right? Or these 4 hour candle lows, right? We can start getting interested. Notice that when we took out this 4 hour low, we did not make an inversion, right? It failed to invert. Now we get a change in state of delivery here. Now it's more interesting. And we have a candle 1, candle 2, right? And so we can typically expect a candle 3. Okay, now if you got stopped out there, right? That would have been, actually no, because the 4 hour candle is still forming. It hasn't closed yet. We need to wait for a close. Okay, so now that it's closed as a candle 2, now we can look to trade candle 3, which this day honestly looks very difficult. But remember also what we talked about is that when we look for reversals in New York, we typically want to see this. The price is just moving down, down. We get a manipulation, and then New York creates its reversal. So now we get a proper change in state of delivery with the candles agreeing, and then we have this. I'll probably be looking at that liquidity there to get tagged. So let's just see if it plays out. Yep. So that's why we prefer to trade candle 3, right? Let's see if the next candle maybe also gives us something. Nope. Move back down into the key level, then maybe a move back up. Well, then it goes into the next day. But yeah, so I guess to critique it, you need to be primarily trading candle 3, right? Um, and in this case, because both Asia and London were consolidations, uh, you know, you're looking for New York to make that move. But yeah, I mean, you were right in seeing that, there's relative equal highs up here. The inversion is not necessarily, well, it is wrong because I don't think that we don't close above it until here. Obviously, we close above it here, but um, in terms of relevance, we need either like a stop run like this, or we need to be in the correct candle, right? Which would be candle 3. Because if you try trading candle 2, that's when you can get stopped out like that. Okay, let's see. So we got the 5 minute, the 4 hour, and the weekly. So kind of like talking about the relevant swings, right? Probably wouldn't be too worried about what's going on back here. And there's a lot going on the chart. So I would probably say it would be best to maybe try to keep things a bit more simpler because there's just like so much going on. It would be easy to get confused. Um, yeah, like it's difficult to even know where these like standard deviations are being anchored from right now. But yeah, like I don't know where these are anchored from. I would assume from here to here. That's where I would have them anchored, unless you're on a lower time frame. this is good. TPing at standard deviations. CISD, also good. Body closing below. Yeah, that's good. Yeah, so as a critique, I would just say try to get these charts a little bit more like not so much going on. The simpler the better. But other than that, solid. And you had a W trade off that change in state of delivery, so it's very nice as well. Kite, yeah, we'll check out Kite. Got stopped by that wick. Stopped just before NY. Okay. Yeah, make sure that you're trading inside of the sessions as well. I entered on inversion confirmation, so you would wait for 4-hour close. I mean, sometimes I'll trade candle 2, but I know what I'm getting myself into if I do go for candle 2 as opposed to just waiting for candle 3. There was a gold trade the other day where I was taking it during candle 2. DZ decided to wait for the candle close, and because of that, I took a loss and he didn't, so they're just lower probability. So if you're gonna trade it, you need to understand that. All right, cool. Let's check out Kite, and then we'll wrap things up. I thought we did notes on this one last time. Okay, so we have a bullish order block here that we've been keying off of. Let's map out our ERL. So we should be able to see on the 1 hour a market maker buy model, which this one does not look very clean. Um, let's see, what does the weekly look like? Just pure expansion. Okay, let's fix this real quick. Let's go to the 1 hour. I mean, the trade for me would have been hitting this daily order block, going for this inversion, and then, I mean, that's money. So at this point, I would probably be using the 4 hour. Um, and I would be looking to see if we can have a change in state of delivery or if we can have a liquidity purge of here, right? And then maybe we have a 15-minute market maker buy model, potentially. Yeah, that looks a lot cleaner, right? Where this is the original consolidation, smart money reversal maybe takes place here. So yeah, I'd be either looking for the low to be taken to purge it or change in state of delivery. No worries, bro. See you later, Jake. All right, guys. It's already 3:05. Wow. Yeah, yeah, that's where I was looking to. Okay, fellas. Well, appreciate you guys coming out. We'll do some more work tomorrow. And yeah, be safe, guys. Trade safe. No crazy trades. No problem. Peace out, guys.